So this account is prepared to make necessary adjustment in the value of assets and liabilities. So at the time of closing down of the business, so this was the balance sheet. So it is very easy to prepare partners capital account. They have given capital, so we shall transfer 40,000, 30,000 and 20,000 as by balance brought down. Hello everyone, I am Harshita, lecturer, Department of Commerce, Vidhyaashram PU College, Temple of Excellence, Mysuru. My dear students, we were discussing 5th chapter of your second PUC syllabus, that is Dissolution of a Partnership Firm. And today we are in the 5th session. So my dear students, in a previous session we have already discussed about meaning of dissolution of a partnership firm, and we had solved certain problems, that is 12 marks problems relating to dissolution of a partnership firm. In today's session we shall continue with difference between realization account and revaluation account. So where do we prepare this realization account and where do we prepare this realization account? So you might be familiar with both the account, but don't get confused with these accounts. Make sure that where we have to prepare these accounts. So the first difference between revaluation account and realization account is when it is prepared. So revaluation account is prepared during admission, retirement or death of a partner. So when do we prepare our revaluation account? We are going to prepare our revaluation account during admission, retirement or death of a partner. Then when we are going to prepare realization account, so this account is prepared on the dissolution of a partnership firm. So this you have to remember, because you have to prepare, or for 12 marks they will ask both questions, both from admission or retirement as well as dissolution of a partnership firm. So make sure that where you have to prepare this revaluation account as well as realization account. So revaluation account is prepared during admission, retirement or death of a partner, whereas realization account is prepared during dissolution of a partnership firm. And the second point is objective. So what is the objective of revaluation account? So this account is prepared to make necessary adjustment in the value of assets and liabilities. Here we are going to consider increase or decrease in the value of assets and liability. To what extent the assets and liability of the firm have increased or decreased during admission, retirement or death of a partner. So that we are going to record under revaluation account. Then what is the main objective of realization account? So this account is prepared to find out profit or loss on assets and repayment of liability. So during dissolution, during closing down of the business, so what we are going to do, we are bringing all the assets together, we will bring all the liability together, we'll sell the assets, so whatever the amount we get, so with that amount we will pay our liabilities. So the remaining amount will be either realization profit or realization loss. So why realization account is prepared? To find out profit or loss on sale of asset and payment of liabilities. Then what is the third difference? That is result. So the third difference is the firm continue to function though with a changed relationship among the partners. So here the firm will continue. It will not end, it will continue. So in while preparing revaluation account, so when we are going to prepare a revaluation account, here when revaluation account are prepared, the firm will continue further, right? So there is no end of business when we are preparing our revaluation account. But when we are going to prepare our realization account, so this realization account is prepared when the firm comes to an end. So when we are going to prepare, so we are going to prepare when the firm comes to an end after preparation of this account. So after preparing realization account, the firm comes to an end, whereas after preparing revaluation account, the firm will not come to an end, it will continue with the new agreement. So it may be in case of admission, retirement or death. So there the old agreement comes to an end and the firm continues with the new agreement. And the fourth difference is when it is prepared. So this account may be prepared many times during the lifetime of the firm. So revaluation account can be prepared many times during the lifetime of the firm. So until the firm exists, till then, to number of times we can prepare this revaluation account. Then what about realization account? So this account is prepared only once, that is during the lifetime of the firm, that is during the dissolution of a partnership firm. Whereas revaluation account, till the business exists, so revaluation account can be prepared number of times. But when we are going to prepare realization account, we are going to prepare only once, that is during dissolution of a partnership firm. So these are the certain difference between realization account as well as revaluation account. Now we shall go through a 12 marks problem. We shall continue 12 marks problem. So go through the problem here. Shruti, Shilpa and Shreya. So who are the three partners here? Shruti, Shilpa and Shreya are partners sharing profit and losses in the ratio 2:2:1. So what is their profit sharing ratio? 2:2:1. They decided to dissolve the firm. So what do you mean by dissolve? So they have decided to close down the business. Their balance sheet as on the date of dissolution was as follows. So they have given the balance sheet on the date of dissolution. So at the time of closing down of the business, so this was the balance sheet. Now they have given liabilities and certain assets. Now let us see what are the liabilities they have given. So they have given creditors, that is outsiders liability, bills payable, outsiders liabilities, Shreya's loan. So what is Shreya's loan? Whether it is outsiders liability? No, because Shreya is partner of the business, right? So she has given loan. So it is not outsider liability. Next is general reserve, and they have given capital of Shruti, Shilpa and Shreya. Now coming to the asset side, we are having cash at bank, debtors, stock, furniture, machinery, building. So this is the balance sheet what they have given. Now coming to the adjustment, let us see what are the adjustment they have given. So normally what happens during dissolution? So they will sell the assets and they will pay the liability, and in adjustment, so certain adjustments are very common. So mostly the first adjustment will be assets realized, and next adjustment will be relating to the liabilities paid off, and you will have one dissolution expenses. So these are the common adjustment you can see in the question. Now go through the first adjustment. So what they have given, the assets realized as follows. So what do you mean by realized? In the sense they have sold the asset, right? So during dissolution of a partnership firm, they have sold certain asset, and they have given at what price they have sold. So debtors realized 10% less than the book value. So how they have sold? They have sold debtors 10% less than the book value. Then the stock realized 15% more than the book value. In the sense they have increased, or at what rate they have sold more than the book value. Building realized rupees 60,000. So here for this debtors as well as stock, so we have to calculate at what amount or at what price they have sold. Whereas for building they have given directly, that is rupees 60,000. Next, the furniture was taken over by Shruti. So during dissolution, it doesn't mean that they have to sell all the assets. So certain assets can be taken by the partner. Clear? So in the same way in this question, what happened? The furniture. So the furniture was taken over by Shruti at rupees 20,000. Here a partner, Shruti, have taken over the furniture of rupees 20,000. Next, the machinery was taken over by Shilpa at rupees 15,000. In the same way, one more asset, that is machinery, was taken over by Shilpa. Next, creditors and bills payable were paid off at a discount of 5%. Now here what they have done? They have certain assets they have sold, certain asset has been taken over by the partner, and next adjustment is about liability paid off. So here creditors and bills payable were paid off at a discount of 5%. So we have to calculate on the book value, that is 5% discount. So book value minus 5%, so we'll get at what price they have paid off the liability. And the next one is cost of dissolution amounted to rupees 1,500. So what is this cost of dissolution? As I told, so during the procedure or during the process of dissolution, what happens? There are certain expenses which have incurred in the organization, which is known as what? Dissolution expenses or realization expenses. So here, how much they have told? Cost of dissolution amounted to 1,500, and they have asked us to prepare realization account, partners capital account and bank account. Clear? Yes. Now we shall move on to the solution. First, what you have to prepare? Realization account. Now, how to prepare a realization account? First, we have to begin with the heading realization account. So, you know the format. We are having debit as well as credit side. Under debit side, particulars, amount. Under credit side, particulars and amount. So, why don't we have date column in our realization account? Because dissolution takes place on a particular date, right? So, there is no need of drawing date column here. Now, what is the first step? While preparing a realization account, we will transfer all the assets. So, we will transfer all the assets except cash or bank as well as profit and loss account. So, we will transfer all the assets except cash or bank as well as profit and loss account. Now, go through the balance sheet. So here what I have told, we have to transfer all the assets except cash or bank as well as profit and loss account. So the first asset is cash at bank. So we will not take in a realization account. Next is data. We have to take stock, we have to take furniture, machinery, building. So we have to take other assets. Now where to take these assets? So we are going to take in the debit side of a realization account. So it's nothing but we will bring all the assets together first except cash or bank as well as profit and loss account. Yes. So we have bought all the assets together in the debit side. Which are the assets? Debtors 30,000, same amount we have to record. Stock 30,000, furniture 22,000, machinery 20,000, building 50,000. So except cash at bank, we have bought all the assets together, right? So these are all what? These are all assets. Now next, so this is the first step. Next step, so we have to bring all the liabilities together except partners loan, partners capital, reserve fund or any other general reserves as well as profit and loss account. Except these 5 items, we have to bring all the liabilities, or you can remember it as if it is outsiders liability, then we have to record only outsiders liability. Other than that, if any liabilities are there in the organization, we are not going to take in a realization account. Now go through the liabilities in a balance sheet. Yes. So what did I tell? Only outsiders liabilities have to be taken. Other than that, if there is any reserves, funds, partners capital, partners loan, so we should not take in a realization account. Now go through the liabilities. So the first liability is creditors. So it is an outsider liability. We have to take. Next, bills payable. We have to take Shreya's loan. Whether it is outsider liability, loan is a liability, but Shreya's loan is what? So it is what? Insider liability, because Shreya is a partner of the business, right? So she is not outsider. So we are not going to take under realization account. Next, general reserve. So we are not going to take, we are going to distribute that general reserve in our partner's capital account. So we are not going to take in realization account. In the same way, capital. So they have given capital. So we'll take in partner's capital account where we are not going to take under realization account. So which are the 2 assets? Creditors as well as bills payable. Now we shall take in the credit side of a realization account. Yes. So by creditors 30,000, next by bills payable 20,000. So these are the liabilities. That is, we have to take only outsiders liability. So this is the second step. Next, So we have bought all the assets, we have bought all the liabilities. Now we shall sell the asset. Clear? So your third step is we are going to sell the asset. So when you sell the asset, what comes to the business? Cash or bank, right? So here in this problem, see the balance sheet. Here they have given cash and bank. So here we are having the word bank. So we are going to take it as bank account. Clear? So even at the end of the solution, we are going to prepare bank account only. If it is only cash, then we will take as buy cash or to cash and we will prepare cash account. Here since they have given cash at bank, we are going to prepare bank account. Now, what we are going to do, when you sell the asset, cash or bank comes to the business, so we are going to record it as by bank account. See how we have recorded. So, by bank account, in the bracket, assets realized. So, what do you mean by assets realized? It's nothing but we are selling the assets. We have sold the assets. Now, where do we get this information about the assets which have been sold? Now go through the adjustments. So they have given directly, right? What they have given? Debtors realized 10% less than the book value. What they have told? So what is the value of debtors? So debtors is 30,000. Now what they have told? Less 10%. So 30,000 minus 10%. So that we have to record in a realization account. So debtors 30,000 was a book value. What they have told? 10% discount. So minus 10%. So you'll get 27,000. Clear? Yes. So or else you can calculate. So how to calculate this 30,000 minus 10%? So 30,000 is the book value. You have to calculate 10% of 30,000. So you'll get 3,000. So 3,000 is the discount, right? Now, then what is the current value? 30,000 minus 3,000. So you'll get 27,000. So this is the value of debtors. So debtors is sold at 10% discount, that is 27,000. In the same way, which is the next one, stock realized 15% more than the book value. So what is the value of stock? Stock is 30,000. 30,000 plus 15% because they have told it is more than the book value, right? So stock 30,000 plus 15%, so you'll get 34,500. Next, what they have given? Building realized rupees 60,000. It is nothing but building is sold at rupees 60,000. There is no other information. Now, which are the three assets we have recorded? That is debtors we have recorded. Next, stock we have recorded. Next, building we have recorded. Still two more assets are pending. Let us see what adjustment they have given on this assets. Now these are the three assets realized. So we shall count all these three and we'll write the total amount. So we'll get 1,21,500. It's nothing but they have sold the asset. So this is our third step. That is selling of assets. Next step is, so we have to pay the liabilities. So we have sold the asset, we got cash or bank. Now using that amount we have to pay our liability. Now we shall see the adjustment what they have given. Creditors and bills payable were paid off at a discount of 5%. So in the sense, 5% discount has to be given on book value, right? Now we shall see what is the value of creditors and bills payable. So go through the balance sheet. Here they have given creditors 30,000. So what they have told? 10% discount. So 30,000 minus 10%. In the same way, bills payable is 20,000 minus 10%. Now how we are going to record in our realization account? So when you pay the liability, cash or bank goes out of the business, right? So we'll record it as to cash or bank account. But in this problem, so we are taking it as to bank account. In the bracket, we have to write liabilities paid off. Let us see how we have recorded. Yes, we have recorded to bank account. In the bracket, liabilities paid. Now, which are the liabilities paid? That is creditors. So, creditors paid, sorry, it is not 10% discount, it is 5% discount. So, here they have given it is 5% discount, right? So, 30,000 minus 5%. So 30,000 is a book value of creditors minus 5% because they have paid at 5% discount. So minus 5%, 28,500. In the same way, bills payable 20,000 minus 5%. So it is 19,000. So you have to, only two liabilities are there. So which are the liabilities? Creditors and bills payable. So we have paid both the liabilities. So we have to total the amount and write the amount in the outer column, 47,500. So this is the fourth step. It is payment of liabilities. Now, there are two more assets which are pending. Which are the two assets? Furniture and machinery. Now let us see the adjustment, what they have told, what they have done with this furniture as well as machinery. So go through the adjustment here. The furniture was taken over by Shruti at rupees 20,000. Now what they have done, furniture is taken over by Shruti and machinery is taken over by Shilpa, and they have given the amount. If any assets are taken over by the partner, then you are going to record in the credit side of your realization account. If any liabilities are taken over, then you will record in the debit side of your realization account. Now here, furniture as well as machinery is an asset, right? So asset taken over. So you are going to record in the credit side of your realization account as, so furniture is taken over by Shruti, right? So you will transfer to her account. Now how do we transfer? By Shruti's capital account. In the bracket you will write furniture taken over and you will write the amount 20,000. Now Shilpa has taken over machinery. So how do you record? By Shilpa's capital account, in the bracket you will write machinery taken over. So what is the amount? 15,000. Clear? Now go through the adjustment. If any adjustment is pending, assets realized, we have recorded. Furniture taken over, we have recorded. Machinery taken over, we have recorded. Creditors and bills payable, we have paid also. Next is cost of dissolution. It's nothing but realization expenses. How much? 1,500. So when you pay realization expenses, what goes out of the business? Cash or bank. So in this problem, it is bank, right? So how do you record? To bank account, in the bracket you will write realization expenses or cost of dissolution. Now let us see how we have recorded is to bank account, in the bracket dissolution expenses or cost of dissolution. How much? 1,500. So now we are done with recording all the transaction. We have recorded all the adjustment. Now what you have to do? We have to balance our realization account. Now how to balance our realization account? So we will add all the amount in the debit side, that is 30,000, 30,000, 22,000, 20,000 plus 50,000 plus 47,500 plus 1,500. So total will get 2,01,000. So this is the total of debit side. Now coming to the credit side, 30,000, 20,000 plus 1,21,500 plus 20,000 plus 15,000. So we'll get 2,06,500. So this is the total of credit side. Now credit side is more. So we'll write 2,06,500 both the side minus 2,01,000. So we'll get 5,500. Clear? So this is the difference. Since credit side is more, it is nothing but realization profit. Suppose debit side was more, it is realization loss. Now credit side is more, so it is realization profit. Now what you are going to do with that realization profit? So we will transfer to partners capital account in their profit sharing ratio. So how to record? To profit transfer to, who are the partner? Shruti, Shilpa and Shreya. So what is the profit? 5,500. And what is their profit sharing ratio? That is 2:1. So this is their profit sharing ratio. So we have to distribute that profit in their profit sharing ratio. So 5,500 into 2 divided by 5, you will get 2,200. And for Shilpa, 5,500 into 2 divided by 5, so we'll get 2,200. Next for Shreya, 5,500 into 1 divided by 5, we'll get 1,100. So now we are done with our realization account. So in this problem, it was realization profit and we have distributed that profit. Now we shall prepare partners capital account. So it is very easy to prepare partners capital account. So you have to be very careful while preparing realization account. Other than that, your partner's capital account and bank account is very easy. Now how to begin a partner's capital account with the heading partner's capital account. Now you will be having debit side as well as credit side, and you have to draw column for each partner. Now who are the partners in this problem? Shruti, Shilpa and Shreya. So 3 columns under debit side, and credit side particular Shruti, Shilpa and Shreya. Now how to begin a partner's capital account? First we will transfer the capital of the partners which is given in the balance sheet, which is given in the liability side of the balance sheet. Now go through the balance sheet. Yes, here they have given capital of Shruti, Shilpa and Shreya. So we have not taken in our realization account. Now we shall take in partner's capital account. Clear? So they have given capital. So we shall transfer 40,000, 30,000 and 20,000 as by balance brought down. Now let us see how we have recorded. Yes, by balance brought down in your credit side. So Shruti's capital is 40,000, Shilpa 30,000, Shreya 20,000. After that, we had prepared realization account, right? So we shall transfer that realization profit or loss to our partner's capital account. So what was the realization profit? That is 5,500. So for each partner 2,200, 2,200 and 1,100. So it was a profit. So we shall transfer in the credit side. So this is not revaluation, it is realization account. So by realization account. So it is profit. So 2,200, 2,200 and 1,100. Now after that, so we are done with transferring capital, we are done with realization profit. Now what you have to do, if there is any reserves, any fund, any profit and loss account, so we have to transfer that. Now go through the balance sheet. Yes, in the liability side, we are having general reserve. So we have to transfer this general reserve, and whereas Shreya's loan, it comes under bank account because we are making payment for her, right? So it comes under bank account. So general reserve, how much? That is 10,000. So we have to transfer that 10,000 in their profit sharing ratio, that is 2:2:1. Now we shall transfer that reserve, that is by general reserve. 10,000 was the general reserve and the profit sharing ratio is 2:2:1. So how to transfer? 10,000 into 2/5. In the same way, 10,000 into 2/5 for Shilpa and 10,000 into 1/5 for Shreya. Now when you calculate, you will get 4,000, 4,000 and 2,000. So now we have transferred our general reserve. Now we shall see if there is anything which is left in the asset side. So there is no assets which is left. This cash at banks comes under bank account. In the adjustment also, there is nothing left to be recorded in our partner's capital account. Now we shall balance our partner's capital account. Now we are done with recording general reserve in their profit sharing ratio. Now there are certain adjustments where they have told certain assets have been taken over by the partners, where we had transferred to their partner's capital account, right? Go through the realization account. Here assets taken over. So here we have transferred to by Shruti's capital account and by Shilpa's capital account, right? So how do we record in our partner's capital account? So we'll record it as to realization account in our partner's capital account. Let us see how we have recorded. So to realization account, in the bracket assets taken over, because machinery as well as furniture has been taken over by Shruti and Shilpa, right? For that we have to record the entry, that is 20,000 and 15,000, and Shreya have not taken over any asset, so let our column be blank. Now we are done with recording all the entries. Now what you have to do? We have to balance, and the balancing figure has to be transferred to cash or bank account. Here in this problem we are going to transfer to bank account. Now how to balance? So when you calculate amount of Shruti in the debit side, so we are having only one amount, that is 20,000. Now coming to the credit side, so we are having So the total amount is 46,200. So I'll write 46,200 both the side minus 20,000. So I'll get 26,200. So this balancing figure has to be transferred to bank account. It means that so the whatever the amount to be paid to the partner, so now we are going to pay that amount. Next, for Shilpa, so we are having only 15,000 in the debit side. Now coming to the credit side, so 30,000 plus 2,200 plus 4,000, that is 36,200. So I'll write 36,200 both the side minus 15,000. So I'll get 21,200. So this is a balancing figure to be transferred to bank account. Now coming to Shreya. So here there is only 1. So that is 0 here. Now coming to the credit side, so we are having 20,000 plus 1,100 plus 2,000. So we'll get 23,100. So 23,100 credit side is more. So we'll write both the side 23,100 minus 0. So we'll get 23,100, which has to be transferred to bank account. Now the last account to be prepared is bank account. Now how to begin? With the heading, we are having debit side as well as credit side. So debit side particulars amount, credit side particulars and amount. Now how to begin a bank account? So we always begin a bank account as to balance brought down. Now where do we get this to balance brought down, that is 6,000? Now go through the balance sheet. In the asset side we have left an amount, that is cash at bank. How much? 6,000. Now we are going to record that amount, that is to balance brought down. To balance brought down 6,000. Now what we have to do? We have to see our realization account and partners capital account. If there is any bank account, so that has to be transferred to our bank account. Now go through the realization account. Now in the credit side, so here there is by bank account, right? So how do you record in your bank account? We'll record it as to realization account, because this bank account is taken from which account? Realization account, right? So to realization account, in the bracket you will write assets realized. Now let us see how we have recorded and what is the amount assets realized. 1,21,500. So to realization account, assets realized 1,21,500. Now again we shall go through realization account. Yes, in the credit side we had only one bank account, so we have recorded that. Now coming to the debit side. So debit side, here there is two bank account, right? So how do you record in your realization account? We'll record it as by realization. No, how do you record in your bank account? So you will record it as by realization account. So what is the amount for liability paid off? That is 47,500. So by realization account 47,500. So by realization account for liabilities paid off 47,500. Now again we shall go through our realization account and see whether there is bank account here. So we have recorded for liability paid off. Next is to bank account realization or dissolution expenses, right? How much? 1,500. So we have to record. So how do you record? By realization account, in bracket you will write dissolution expenses. Clear? So you have to write in bracket because you will get confused, because more than one we are going to record our realization account in our bank account. So make sure that you will write in the bracket. So let us see how we have recorded. Yes, by realization account, in the bracket expenses, or you can write it as dissolution expenses. So how much? 1,500. Now again in the realization account there is no bank account in the debit side. Now moving on to partners capital account. So here there is bank account. So the balancing figure has been transferred to bank account, right? So we have to transfer this amount. So how do you transfer partners capital account debit to bank account? So how do you record in your bank account? By partners capital account. So you can't write all the amount together. Individually you have to write the name of the partner and write the amount. That is by Shruti's capital account, by Shilpa's capital account and by Shreya's capital account, and we'll write this balancing figure amount. That is by Shruti's capital account 26,500, by Shilpa's capital account 21,200, by Shreya's capital account 23,100. Now we are done with partners capital account. There is no bank account. Now go through the balance sheet. We have left a transaction. We have left Shreya's loan account, right? In the liability side, we are having Shreya's loan account. So how do you record Shreya's loan account? In the sense, we have to pay her loan, right? So what is the journal entry when we pay Shreya's loan? Shreya's loan account debit to bank account, right? So how do you record in your bank account? By Shreya's loan account, how much? That is 8,000. Now go through the bank account. Yes, by Shreya's loan account, and the amount is how much? 8,000, and we have paid Shreya's loan. Now we are done with recording all the transaction in our bank account. Now we shall balance the amount. Now when you add debit side, so we are having 6,000 plus 1,21,500, so we'll get 1,27,500. In the same way, when we add credit side, so we are having 47,500 plus 1,500 plus 8,000 plus 26,200 plus 21,200 plus 23,100, so we'll get 1,27,500. So your bank account, so when you prepare your bank account, the total of debit side should be equal to total of credit side. Clear? So this is how we are going to prepare accounts under dissolution of a partnership firm. My dear students, in today's session, we learned what is the difference between realization account and revaluation account, and we had solved a 12 marks problem on dissolution of a partnership firm. See you all in my next session. Till then, take care. Thank you.